Welcome to the Deep Dive. We're the show that, well, we take something that looks pretty dense, like a Q2 earnings report.
Right, the kind most people might skim over.
Exactly. And we turn it into something genuinely useful, a shortcut to being really informed. Because honestly, these reports, they're packed with insights.
Absolutely, not just about the company, but bigger trends, global commerce, what consumers are doing, even new tech.
And that's what we're doing today, a deep dive into Avery Dennison Corporation's second quarter 2025 earnings.
Now, if you haven't heard of them, they're leaders in material science, digital ID solutions. Their motto is Inspired Brands, Intelligent World.
Yep. So our mission today, cut through the jargon. We've got the official press release, the earnings call transcript,
All the raw material.
and we're pulling out the key nuggets for you, giving you a clear picture of Avery Dennison, yes, but also the markets they touch. Think of it like peeling back the layers.
And as we do, you'll see how this company, often working behind the scenes, is actually a pretty good barometer for bigger economic shifts.
That's a great way to put it, a barometer. Okay, so let's start with that big picture. How did Avery Dennison handle Q2 2025? It was definitely dynamic.
Challenging, I'd say.
Right. On the surface, their adjusted earnings per share, EPS, looks solid, $2.42.
Which is up 5% from
Yeah.
Q1, and importantly, pretty much level with last year.
Exactly. Net sales were just under $2.2 billion. Organic sales, so stripping out currency and acquisitions, dipped slightly, down 1.0%.
Okay, so a slight dip there.
But the real story for me maybe was the cash flow. Adjusted free cash flow, near $190 million.
Yeah, $188.9 million technically. That's a strong number, and it tells you something, doesn't it? Their capital management.
It signaled confidence, right?
I think so. Despite all the uncertainty out there, they actually increased their dividend by 7% up to $7.94 per share.
And they've been doing that consistently for over 10 years now.
Right? It's not just talk. In the first half of this year alone, they sent over $500 million back to shareholders.
$500 million. How did that break down?
Yeah, well, through those dividends, obviously, but also share buybacks. They repurchased about $360 million worth, taking 2 million shares off the market.
So fewer shares outstanding.
Exactly. Year over year, their share count is down by 2.8 million. It suggests they think their stock is a good buy, and they're prioritizing those shareholder returns, maybe seeing steady cash flow ahead.
And they managed all this while facing some pretty big headwinds. You mentioned challenges. Trade policy changes were a big one, weren't they?
Oh, definitely, both direct impacts and indirect ones.
So how do they handle the direct costs, tariffs and the like?
They use what they called their proven playbook, which basically means, adjusting where they source materials from.
Shifting things around globally.
Yeah, and applying some selective price surcharges, like you said before we started, a bit like global whack-a-mole.
Yeah. You fix one thing, another pops up. But what about the indirect effects? Those sound trickier.
They are. They estimate those indirect tariff effects actually knock more than 10 cents off their EPS for the quarter.
Wow, 10 cents. Where did that hit come from?
Mostly impacting demand from their customers, especially in apparel and general retail sourcing.
So customers getting nervous about tariffs, maybe ordering less.
Seems like it. They mention ongoing near-term uncertainty, and customer feedback is still pretty muted on that front. It's not just the direct cost, it's the ripple effect through the supply chain. Makes people hesitant.
Okay, let's unpack this. It seems like they delivered solid results despite a lot of headwinds. So what does this all mean for a company like Avery Dennison?
What's fascinating here is their resilience. Despite these significant external pressures, particularly from trade policy, they managed to maintain their earnings per share, largely by leveraging their diverse portfolio and proactive mitigation strategies. This raises an important question. How adaptable is their underlying business model?
Good question.
Oh.
So how does that resilience look when you break it down into their main business segments? Let's start with the materials group. That's the bigger one, right? Focused on stability, high-value stuff.
That's right. Reported sales there were up just slightly, 0.2%, hitting $1.6 billion. Organically, though, down 1.0%.
Okay. But profitability?
Strong. Good productivity, good margins. Their adjusted EBITDA margin, that's a key profit measure, was healthy, 17.8%.
You mentioned high-value categories. How important are those now?
Increasingly important. They now make up over a third of the sales in this materials group. And crucially, they're growing faster than the, let's call it, base business.
Which categories are we talking about?
Well, areas like graphics and reflectives, they were up high single digits.
What's driving that?
Strength in Asia, things like new customers, paint protection films for cars, and also North America with those cool color change films for customizing cars.
Yeah, you see those around.
Exactly. And they expect that trend to continue. Performance tapes and medical also saw some growth, low single digits.
So that shift to high value, it seems to be working. It's like they're insulating themselves a bit.
Precisely. It helps shield them from some of the volatility in more basic materials and aligns them with industries looking for specific performance.
What about different regions? Any standouts?
North America was strong, especially in those film categories we mentioned. Europe was down,
Why was Europe down?
partly because customers apparently bought extra stuff in Q2 last year, pulled orders forward, making the comparison tougher this year.
Ah, the base effect.
Exactly. Emerging markets showed solid growth. Asia was a bit softer, also linked to some of that pull forward from last year.
Okay. And raw materials, always a big factor.
They actually saw a little bit of cost deflation globally in Q2, sequentially, if you exclude the direct tariff hits.
Oh, interesting. But tariffs complicated that.
Yeah, higher tariffs, especially U.S.-Europe ones, kicked in mid-quarter. They mostly offset them with sourcing tweaks and those surcharges we talked about.
And looking ahead, Q3.
They're expecting low single-digit inflation for Q3, and that includes the tariff impacts.
Got it. So materials group.
Yep.
Stable, margin-focused, shifting successfully to higher value.
That's the picture. A good example of how diversification within a segment helps absorb shocks.
Okay, let's pivot to the other main segment, the solutions group. This one faced more headwinds, particularly in apparel, right? But maybe some bright spots, too.
Yeah, that's fair. Overall sales here were down 2.6% to $670 million. Organically, down 0.8%.
But margins improved slightly.
They did.
Oh.
Adjusted EBITDA margin up 30 basis points to 17.1%. So managing costs well, it seems.
But the big challenge was apparel.
Definitely. Sales in their overall apparel categories were down 6% in Q2. Orders were way down in April, high single digits.
Oh.
They did improve through the quarter, only down low single digits by June. But, as we said, customer sentiment is still described as muted.
But within solutions, they have some specific platforms. What about Embellix? That sounds interesting. Performance athletic stuff, fan engagement.
Right. It's usually a high-growth area, but it was actually down in Q2.
Why was that?
Same reasons, really. Lower sourcing demand overall, and specifically slower orders from some big U.S. performance brands.
So temporary dip, maybe?
They think so. They expect growth to pick up later this year, partly looking ahead to the 2026 World Cup, interestingly.
Event-driven.
Yeah, the CEO broke it down. Embellix relies on big brands, customization for team sports, and these sort of ad hoc events, often with digital triggers involved too. They're looking for growth again in Q4.
Okay, so some hope there. What else is in solutions? You mentioned VSCOM.
Yes, VSCOM. That's their suite of solutions for the retail shelf edge. Think pricing labels, promotional displays, that sort of thing.
And how did that do?
That was a real bright spot, up roughly 10% in Q2.
Wow, 10%? What drove that?
A big part was a successful rollout they did with CVS Health here in the U.S.
Interesting.
The CEO called it largely a data composition engine. It thrives when retailers are changing prices and running promotions frequently.
So it benefits from retail activity,
Yeah.
even if overall volumes are maybe soft? Clever.
It really is. It shows how finding niches that help other businesses become more agile, especially around pricing, can be a growth engine even in tougher times.
Okay, so we've covered the two main segments. Materials, more stable. Solutions mixed with apparel weakness, but bright spots like VSCOM. Now, let's talk intelligent labels, IL. This feels like the big strategic bet for the future.
Absolutely. Huge potential there, which is why it was quite striking to hear the CEO say candidly that he was not satisfied with the current growth and earnings path for IL.
Not satisfied, even though sales were flat year over year and actually up mid-single digits from Q1.
Right. But the context is key. Over 70% of that IL business is tied to
Apparel and general retail, which were down.
Exactly. Customers cutting orders, reducing inventory, that directly drags down IL growth in the near term. So that dissatisfaction isn't just talk, it's a clear signal they need to accelerate, not just tread water.
Okay, so apparel's weighing it down. But wasn't there good news elsewhere in IL?
There was, and this is important. If you look at food, logistics, and their other non-apparel IL categories combined, they were up mid-teens.
Mid-teens, that's strong.
Very strong, especially food. Their big collaboration with Kroger is ramping up nicely, as expected, and they have a strong pipeline with other grocers, too. Logistics also saw strong growth.
And the returns. Are these applications paying off for customers?
Apparently, yes. The ROI's returns on investment in food and logistics are actually exceeding expectations.
Yeah.
That's a great sign for future adoption.
So the CEO's dissatisfaction, even with those bright spots, what are they doing about it?
Two main things. First, improving network efficiency. That means tweaking their global manufacturing and supply footprint, partly reacting to those trade policy shifts, cutting out wasted steps.
Makes sense. Get leaner.
Second, and this is the exciting part, expanding innovation. This really raises a key question. Given the apparel slowdown, how will these new innovations, especially in food and logistics, start to reshape the IL portfolio mix?
Right. And what kind of innovation do we see?
Well, in food, they've launched the first microwavable RFID tag for frozen items. Imagine tracking frozen goods digitally right through the supply chain, even in the microwave.
That's pretty cool.
And a new recyclable tag approved by the APR, that's the Association of Plastic Recyclers, for perishables in plastic clamshells. Think berries, salads. Plus, they mention new proprietary IP coming in the second half to expand further into protein and other perishables.
So solving real pain points for the food industry, waste, tracking, recyclability.
Exactly. And even in apparel, despite the slowdown, they're not standing still. They're building on their loss detection systems, working with retailers like Inditex.
Improving the actual tags, too.
Yeah, improving the inlay, designs the chip and antenna so they get read more reliably in busy stores. And supporting self-checkout systems for big names like Uniqlo's parent company, Fast Retailing, and Decathlon, preparing for how retail is changing.
What about competition in this space? It seems like a hot area.
The CEO described it as balanced competition, but he stressed Avery Dennison is the market leader, has the majority share, and they actually expect that share to nudge up a bit with these new rollouts.
And the overall market potential, they still see it as huge.
Absolutely huge. They reiterated their view. It's a potential market of $300 billion units annually, or about $8 billion in value.
So still early days, really.
Very much so. That focus on innovation, even when facing headwinds, it just underscores their long-term belief in this market. They're not just reacting, they're trying to shape it.
That's a massive strategic commitment. Okay, let's zoom back out a bit.
Yeah.
Financial health, the road ahead. How are they positioned?
Very solidly, it seems. Their balance sheet is strong. Net debt to adjusted EBITDA ratio is 2.3x. That's quite healthy, gives them flexibility.
And how are they using that flexibility? Capital allocation.
It's a disciplined approach. They're investing organically in the business, obviously, paying those increased dividends we discussed, buying back shares. And interestingly, they mentioned a very robust M&A pipeline.
Oh, looking for acquisitions.
Seems like it. Aimed at accelerating their strategic goals and boosting what they call EVA, economic value added, over the long run. So smart value-adding deals, presumably.
And controlling costs internally. Are they finding savings?
Yes, significant savings from restructuring. They expect about $50 million for the full year, net of the costs to achieve it. And they already realized about $30 million in the first half.
How else are they managing overheads?
Well, their SG&A expenses, selling general administrative costs, were actually lower year over year in the first half. Partly restructuring, but also cutting back on discretionary spending like travel and lower bonus accruals. Shows a tight grip on the purse strings.
Okay, so looking forward now. What's the guidance for Q3?
Adjusted EPS guidance for Q3 is $2.24 to $2.40. Right around the midpoint, that's pretty much comparable to Q3 last year.
What assumptions go into that?
Typical seasonality, mostly. Like, August holidays in Europe usually mean a bit of a sequential dip. Same with apparel seasonality, though they expect a small currency benefit to help offset that slightly.
And the outlook specifically for apparel in Q3, still soft.
Yes, they're still assuming soft apparel volumes. They expect the apparel business overall to be down low single digits year over year.
Which is actually better than this 6% decline in Q2.
Yeah. It is. So maybe, just maybe, the apparel headwinds are easing up a little bit. Fingers crossed for them.
Any word on the full year?
No specific full-year guidance was given. But they did say they expect to get back to year-over-year earnings growth in Q4, assuming the macro picture doesn't worsen significantly.
And cash flow for the year.
They're targeting roughly 100% free cash flow conversion for the full year, which basically means turning nearly all their adjusted net income into free cash flow.
That's strong. A sign of good management in tricky times.
Definitely. Focus on cash generation and retention.
So, wrapping this up.
Yeah.
What does this all mean for you listening? It really sounds like Avery Dennison is playing the long game here.
I think that's right. They're navigating these immediate challenges, the trade stuff, the apparel softness, but they're clearly preparing for different scenarios while really doubling down on innovation, especially in IL.
They're not just getting pushed around by the market. They seem to be actively trying to shape parts of it,
Right.
adapting their strategy as the global economy shifts.
Yeah, this Q2 really showed that resilience. Materials group, stable, pushing high value. Solutions group, challenged but finding those bright spots like the SCOM, and innovating hard in IL for food and logistics despite the apparel drag.
And underpinned by strong financials and disciplined management.
Exactly. It positions them pretty well to handle the ongoing uncertainty and hopefully capitalize when things pick up.
So here's a final thought for you. Consider how companies like Avery Dennison, the ones really focusing on localized innovation, making their supply chains more agile, especially with all these global trade shifts. They're not just surviving.
No, they're quietly laying the groundwork.
Yeah, groundwork for the next generation of how things are made, how they're tracked, how we consume them. It makes you wonder what's going to be the next high-value category that emerges from these kinds of strategic pivots.
A great question to ponder. What other industries might be making similar moves, and how could that reshape things down the line?